Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
And welcome to the Global View on this Wednesday. Well, it was a mostly negative session on global equity markets overnight, with contracting manufacturing activity in Europe weighing on sentiment. On Wall Street, the S&P 500 and Nasdaq slipped as investors await jobs data later in the week and earnings results from mega-cap tech companies. The Dow rose, buoyed in part by Caterpillar, with the company reporting a rise in second quarter profit, though it did warn of a sequential fall in current quarter sales and margins. Elsewhere on the earnings front, Advanced Micro Devices forecasts a strong fourth quarter and expects to have artificial intelligence hardware that can challenge Nvidia's dominance. Uber slipped into reverse after the ride-hailing company missed second quarter revenue expectations, but reported its maiden operating profit. Pfizer finished lower, having reported quarterly revenue which fell short of expectations, with the pharmaceutical giant hit by declining sales of its COVID products. And Merck posted narrower than expected second quarter loss and raised its full year profit forecast on the strength of its two top selling products, its cancer immunotherapy Keytruda and its cancer vaccine Gardasil. And shares of Norwegian Cruise Line sank after it forecast third quarter profit below estimates, citing higher costs. Well, let's get across what's going on in earnings season in the States and how that's likely to inform portfolio positioning. Bob Desmond is portfolio manager from Claremont Global. He joins us now. Bob, very good to catch up with you again. Thanks much for joining us on AusBiz.
Hi, Andrew. How you going?
Good. What's your takeout thus far? Because from earnings season stateside, with second quarter earnings from S&P 500 companies now estimated to have fallen just over 6% year on year, which is a slight improvement from what we saw just a week ago.
I mean, for the most part, for our companies, Andrew, they've been really strong. I've been very pleased with earnings season. If you actually look at the average we've had so far, and I think 8 of our companies have reported, we're doing on average 9 to 10% organic revenue growth. So it's been really strong. I think, tech has been pleasant surprise. There is softness there, but if you look at something like Microsoft, they did 10% constant currency revenue growth. Alphabet did 9, so that was pretty solid. You are seeing a slowdown in IT services, but we've been pretty happy there. There is signs of softness in the US, especially in the consumer market, especially at the top end. So companies like LV, but generally pretty strong. If you look at the industrial sector, autos have been very strong. There's a 40 million backlog there. Aero's been strong. We still got less flights than pre-COVID. So it looks to me that things have been pretty good.
Yeah, you mentioned consumer stocks. In fact, we had Starbucks out after the bell. They're missing market expectations there, particularly for sales, as demand tapering, certainly in North America there. So do you have some concerns in particular for those consumer-facing stocks, given what we're seeing with the broader US economy?
I'd say, Andrew, it's really more at the top end. So something like, if you looked at LV's results, it's more at the top end. But you look at the broad consumer, we still got that shift, obviously, from goods to services, the post-COVID sort of splurge. But actually, I think the consumer's in pretty good shape. You can see that from the American Express results, the Visa results. They reported 13% constant currency revenue growth. So I think the broad consumer is still in very good shape. We've got very low unemployment. So it's really just, I think, more at that top end in the US.
As we've seen, Bob, certainly the first half of the year, we had that concentration with the so-called Magnificent Seven that have really driven those market gains there, those tech firms. Are we seeing that rally broaden, though? Is that a positive sign that you're seeing?
No, I think it is very much a positive sign, Andrew. It is interesting how markets climb the wall of worry, and they're often very forward indicating, and they rise, and then later on you find out that actually what's been going on. But I mean, I think we've said for a while that US banking crisis, inverted commas crisis, has been overstated. When we visited the States earlier this year, most of the people we spoke to said that the banks were in very solid shape. So I think that's helped, and you've seen a very strong rally in some of those regional banks, mid-cap banks. So I think things have broadened. I would caution that a little and temper that a little bit. I think valuations have moved quite a way, and we always are bottom up, and we look at what our stock valuations are saying, and things have moved quite a long way from October last year. So whilst the economic news is good, I would say the valuation news less so.
Bob, you mentioned at the start there, you've seen some 8 of the companies in your portfolio having reported. Can you give us an example of what you're actually invested in at the moment and what you're seeing?
So if you look at, I've mentioned the tech shares, something like, Microsoft 10%, something like Alphabet 9%. If you look at our business services companies, ADP, they had organic revenue of 10. Something like Aon had organic revenue of 6, 7 for the first half. We haven't had any of our healthcare companies report. I think there has been softness in healthcare, and they've performed quite badly this year and lagged. So I think there is potentially some opportunity there from post sort of COVID catch up. If you look at other areas, brands, LV, another unbelievable result, 17% constant currency revenue growth. So, across the board, it's been pretty strong. I'd say the one that was a slight disappointment for us was in, what we call our financial plumbing businesses. So something like Equifax, they're pretty much flat, but that's really much because of the mortgage business, which is 20% of their business, and mortgage inquiries are down over 30%. So that's still soft. But in the main, it's been very solid.
How skewed are you to tech at the moment? Of course, you mentioned some of those results there, Microsoft included. Later this week, of course, we do have Apple and Amazon. Are you there in those stocks at the moment? What are you looking for?
Yeah, we've been long-term holders, Andrew, of Microsoft, Alphabet, and Adobe. So the first two have reported. So it's been around about a third of our portfolio. We were very bullish at the end of last year. Valuations had become very attractive, and people kind of threw the baby out of the bathwater. I think, post that sort of tech bubble, if you like, 2 years ago, the fintech bubble, valuations in so many areas got very silly. But actually, big tech, I still don't think is actually that demanding. Alphabet, last time I looked, something around about 21 times earnings, even Microsoft 30 times forward earnings. I don't think that's particularly demanding for the quality of businesses that they have. But the share price moves have been quite a bit, and we have been topping some of our tech holdings. Something like Adobe's up 65% a year. It's amazing how the narrative has changed there. December we were worried about the Figma acquisition, and now with this whole AI theme playing through, that's up 65%, Alphabet's up 40%, Microsoft pretty much the same. So we have been trimming our tech holdings.
Well, I mean, you mentioned that narrative around AI, which we've seen that frenzy. Do you have any concerns there that perhaps too many investors have got caught up in that rather than looking at the fundamentals? But I mean, of course, most people would agree that this is something of a revolution that we're seeing right now.
I think we've got a little bit of caution around it, let's say. And I think, and again, you have to look at the magnitude of the move. So, Adobe up 65%. Well, their earnings aren't up 65%. So that margin of safety we're always looking for is obviously closed. Most of the narrative is that this is game changing, but how do we incorporate that into our 5-year earnings numbers? I think is questionable. So I do think, and it was very noticeable when we were in the States, just listening to the chatter and, the conference we attended, AI was huge. Every company was asked about it. And as my colleagues see, when burger flippers start talking about the AI, maybe we've got a bit ahead of things.
All right. So all that said then, Bob, how are you positioning your portfolio? Have you made some adjustments?
We have, Andrew. So as I said, we have been topping tech. It's been a really strong performer for us. We still got big positions there. But there have been some other areas of the market that are lagged, and we do like when you get that dichotomy in the market. So we have been topping up consumer discretionary. We have built a new position in discretionary name, which I can't quite say because we're still trading. But that's been a really good area for us to be fishing. Also, I think healthcare has been interesting. You've seen the lag there with post-COVID. Some of the replacement cycles are a bit muted. So that's kind of across the portfolio and sectors what we've been doing this year.
You mentioned healthcare. Where would you be looking in particular there? And I look at some of those healthcare sort of tech-like stocks, if you like, which, well, a couple of them having just reported, of course, including Merck and what else did we get today? The other one being, of course, Pfizer. Where are you looking there?
Well, Andrew, we do try and keep things simple. So we stay away from pharmaceuticals and medical devices. but we do like precision instruments and services. So I think the one we have been topping up on is Agilent Technologies, which is a precision instruments business. It's lagged, it's down quite a bit this year. It was a very strong performer through COVID. So we have been topping up there. We also own Zoetis, which is animal healthcare. So whilst we don't like human pharmaceuticals because of the complexity around phase 3 drug approvals, generic challenges, payer systems, US politics, etc., animal healthcare is a much more interesting area because it's all privately funded, it's direct distribution, most of the drugs are off patent. So those are the kind of holdings we hold in that space.
And Bob, beyond US listed stocks, anywhere else you're finding interesting at the moment?
No, generally our portfolio does skew to the US owner. It's just where we find the best businesses at the best valuations. We have seen a couple of names in Europe start looking interesting as well, more in that precision instrument space. But more often than not, we find the US quality growth names trade at a discount to their European counterparts.
Bob, great to get across with your outlook at Claremont Global. Thanks so much for joining us.
Thanks, Andrew. Nice to talk to you.
All right, just a check of the markets before we go. In fact, where we're likely to get going, as you can see, SPI futures down more than 0.5%. That's reflecting what we saw on global markets overnight as investors take stock ahead of some more job numbers coming out of the States, but also some weaker manufacturing data that we saw in Europe. All right, we're just a couple of minutes away from the open. Stay with us.